Welcome to this video on income statements for investors. As an investor, it's essential that you understand the financial performance of the companies that you invest in. One of the key tools for evaluating a company's financial performance is the income statement, which provides an overview of the company's revenue and expenses over a particular period. By analyzing the income statement, you can gain valuable insights into a company's profitability, efficiency, and financial health, which can help you make more informed investment decisions. In this video, we will provide an overview of income statements, discuss why they are important for investors, and provide guidance on how to analyze them. Make sure you stay until the end as we will be covering the most important financial ratios from the income statement. These will be very useful in evaluating the financial performance of companies you are looking to invest in. By the end of this video, you should have a better understanding of how to use income statements when looking to make investments. If you like this content, please remember to hit the like button and subscribe. Let's get started. An income statement, also known as a profit and loss statement, shows a company's revenues, expenses, and profit during a specific period of time, typically a month, quarter, or year. Here are some key reasons why investors should understand income statements. 1. Assessing profitability. The income statement shows a company's revenues and expenses, allowing investors to determine its profitability. By analyzing the income statement, investors can determine whether a company is generating profits, how much profit it is generating, and how its profitability has changed over time. 2. Evaluating efficiency. The income statement allows investors to assess a company's efficiency by analyzing its cost of sales and operating expenses. By comparing these expenses to revenue, investors can determine how efficiently a company is operating and whether there are opportunities to improve its operational efficiency. 3. Comparing companies. Income statements allow investors to compare companies within as well as across different industries. By analyzing the income statements of different companies, investors can determine which companies are performing well and which ones are struggling. 4. Identifying trends. Income statements can be used to identify trends in a company's financial performance over time. By analyzing income statements from multiple periods, investors can determine whether a company's profitability and efficiency are improving, declining, or remaining stable. 5. Making informed investment decisions. Ultimately, understanding income statements allows investors to make informed investment decisions. By analyzing a company's financial performance, investors can determine whether it is a good investment opportunity and whether its financials align with their investment goals and risk tolerance. The key steps in analyzing income statements include: 1. Look at revenue growth. Revenue growth indicates that a company's products or services are in demand and it is expanding its customer base and/or increasing the sales of its existing products or services. Revenue growth can also indicate that a company is gaining market share from its competitors, hence the company is able to compete effectively in its industry and can gain traction with consumers. To understand whether a company's revenue growth is above or below average, it's helpful to compare it to industry benchmarks. This can provide insights into how well the company is performing relative to its competitors. The drivers of a company's revenue growth include factors such as increased sales, product innovation, new market penetration, or acquisitions. By understanding what is driving revenue growth, investors can gain insight into a company's long-term prospects. Ideally, investors should look for companies with consistent revenue growth over time. 2. Analyze operating expenses. Operating expenses are the costs associated with running a business, such as salaries, rent, and utilities. Investors should analyze a company's operating expenses to ensure that they are in line with the company's revenue. Companies may implement cost management strategies to reduce their operating expenses. It's important to evaluate whether these efforts are effective and sustainable. For example, a company may reduce its marketing expenses to improve profitability, but this may also negatively impact revenue growth. 3. Look for one-time items. One-time items such as gains or losses from the sale of assets can have a significant impact on a company's net income. Investors should look for these one-time items when analyzing an income statement to determine the company's ongoing financial performance. 4. Consider industry-specific factors. Investors should consider industry-specific factors when analyzing an income statement. For example, a technology company may have higher research and development expenses than a retail company, so investors should adjust their analysis accordingly. 5. Compare income statements. By comparing income statements over multiple periods, investors can identify trends in a company's financial performance and can assess its growth potential. This includes projecting future revenue and earnings growth and evaluating how the company is likely to perform under different economic scenarios. 6. Calculate financial ratios. Financial ratios are a useful tool for analyzing income statements. There are several financial metrics that investors generally use to analyze a company's financial performance. Here are some of the most common financial ratios taken from the income statement. Earnings per share or EPS. The EPS ratio is calculated by dividing net income by the number of outstanding shares. This ratio represents the portion of net income that is allocated to each share of stock. A higher EPS indicates that the company is able to generate more earnings from each share on issue. EPS is a key part of the price-to-earnings ratio. Price-to-earnings or PE ratio. The PE ratio is a valuation metric that compares a company's stock price to its earnings per share. The ratio is used to determine whether a stock is undervalued or overvalued relative to its earnings. Price-to-sales or PS ratio. The PS ratio compares a company's stock price to its revenue per share. This ratio is used to determine whether a stock is undervalued or overvalued relative to its revenue. Return on equity. The return on equity ratio is calculated by dividing net income by shareholder equity. This ratio represents the percentage of each dollar of shareholder equity that generates income. A higher return on equity ratio indicates that the company is able to generate more income from its shareholders' investments. Gross margin. Gross margin is a profitability metric that represents the percentage of revenue that remains after deducting the cost of goods sold. This metric is used to assess a company's ability to generate profits from its products or services. Gross margin ratio. The gross margin ratio is calculated by dividing gross profit by revenue. This ratio represents the percentage of each dollar of revenue that remains after deducting the cost of goods sold. A higher gross margin ratio indicates that the company is able to generate more profit from each dollar of revenue. Operating profit margin ratio. The operating profit margin ratio is calculated by dividing operating income by revenue. This ratio represents the percentage of each dollar of revenue that remains after deducting operating expenses. A higher operating profit margin ratio indicates that the company is able to generate more profit from its core business operations. Return on assets ratio. The return on assets ratio is calculated by dividing net income by total assets. This ratio represents the percentage of each dollar of assets that generates income. A higher return on assets ratio indicates that the company is able to generate more income from its assets. In summary, there are many financial metrics that investors use to analyze a company's financial performance. By using these metrics, investors can gain valuable insights into a company's profitability, valuation, liquidity, and financial health, which can help them make more informed investment decisions. Thank you for watching our video on income statements for investors. We hope that you found this video informative and useful in your investment journey. Understanding the financial health of a company is crucial when making informed investment decisions, and analyzing income statements is an essential part of this process. By comparing financial ratios, identifying trends, and evaluating a company's growth potential, you can make informed decisions that align with your investment goals and risk tolerance. So, whether you're a seasoned investor or just starting out, we hope that this video has provided you with valuable insights and knowledge to make smarter investment decisions. Please don't forget to like, share, and subscribe to our channel for more informative videos on finance, investing, and wealth management. Thank you for your time, and we'll see you in the next one.